Good morning, everybody. I've been asked to make a video about how to make GameStop stock go up. All right, let's go. Let's see. What did I want to talk about? I wanted to talk about just a little bit of history up till today. So we know what happened in January. It went up, came down, and a lot of people realized that a lot of people didn't sell their stock. They held through all of this. And a lot more people joined in February. They saw this running up and they figured that the play wasn't dead. So a lot of people bought, and we all thought, that if we kept buying, that it would eventually push the stock prices up. And I'm here to say that that's probably not true, and it's because of dark pools. And we know from studying dark pools to the best of our ability that dark pools are where institutional players go to exchange shares of a company. And the purpose of a dark pool is so that it doesn't affect the overall volatility of a stock on the open market, right? Typically, normally, or previously, dark pools were used for large block trades that would affect a stock too much, especially if there wasn't enough liquidity there for people buying the shares that another institution needed to dump. What we've seen with some stocks lately, this year especially, is that some stocks have a very high amount of shares being traded through the dark pools. And there's a couple places where you can see this, or at least you used to be able to see this. And this is not an endorsement, but Unusual Whales is one of them. I'm not paid by Unusual Whales. I have no affiliation with them. Whaley gave me 1 month free to try it, but I didn't really use it. But there's a option here called Flow, and there you can look at dark pool activity. Now, I'm not going to show it because I don't know if that's a break in terms of service or something like that. So if you go there, you can check out dark pool flow, and there used to be a pie chart that would show you buy versus sell activity, and it's not there anymore, and I'm not really sure why. Stocko Tracker was another place that got popular that added dark pool flow. And again, I don't know why, but the data is missing. So we don't know how much is flowing through the dark pools anymore. Whaley will publish the volume, but again, without knowing buy side versus sell side on it, which it used to say, there's not a whole lot of information there. GameStop, what I used to see in the brief period of time that I had the service and was checking, a lot of buy orders would be routed to the dark pools. And what that means is that all the retail buying pressure, a portion of that, would be off exchange, and then we wouldn't see the price go up. Now, conversely, I'm not going to name any names, but if you know me, you probably know what I'm talking about. Other companies had the opposite happen. Sell orders would be routed to the dark pools, and that would theoretically prevent the price of a stock from going down. That seems manipulative to me. That seems pretty obviously manipulative to me. More recently, another stock that we saw a lot of dark pool activity trading was Tesla. A week ago, Tesla sold off pretty heavily, right? Right here, this was the weekend where Elon published a tweet. He tweeted a poll that asked the people of Twitter if he should sell 10% of his stock. And the votes came out to be a yes, and he was going to sell. And that weekend, the German market sold off like 7%. We can use a ruler to see if this is actually 7%. Yeah, about 6%. And then by the next morning, it dropped a lot more. But this is the Monday, and it didn't go down as much as we expected. And then it rebounded. And then the Tuesday is when it really started dropping. But I was looking at dark pool flow here, and a lot of sell orders on Monday were being routed to the dark pools. I can only assume that by Tuesday, institutions were ready for this. Maybe they had all the puts that they wanted to sell sold, and maybe I don't know. I'm theorizing here, right? Because obviously they weren't ready on Monday. That's not what it seemed that way anyway. And by Tuesday they were ready for this, and so dark pool activity changed. between Monday and Tuesday. That seems manipulative to me. Anyway, the other weird thing about all the stuff that we've been seeing lately, especially in a number of tickers, is that you have to look at the size of the float, right? So this is Investopedia, and here's the definition. A key takeaway of company's float is that there's an inverse correlation between the size of a company's float and the volatility of a stock's price. In other words, if a company has a very small float, which GameStop has like maybe 60 or 50 something million shares in the float, versus Tesla, which has, you know, 1 billion shares outstanding and the float is 820 million, 820.5 million. And you can look up whatever other company that you know has a lot of shares, right? What it means is that technically, the larger the number of shares in the float, the more stable that company should be. So we shouldn't be seeing this sort of volatility in these huge companies with a lot of shares. Right? Now, if we go to a chart of Tesla, and we can graph this using Bollinger Bands. Shout outs to Howie. Yeah, shout outs to Pone too. Why not? She hates technical analysis. Look at this. I put up 2 Bollinger Bands, right? One is a standard 2 standard deviation Bollinger Band, and I increase this one to 3. We can even increase this to 4. This is a trading view. It's free to chart online if you only want to add a couple of indicators. If you want to add more, and I really do like adding a lot of indicators, you have to pay. If you got the money, TradingView is worth it. Not a sponsored ad. I just really like the software. Okay, look at this. This Tuesday drop exceeded 4 standard deviations. Let's see if we can graph this out, right? 6, 7 standard deviations. That's ridiculous, right? Like a 4 standard deviation has a less than, or 0.15% chance of happening randomly. That's what that is, right? That's 4 standard deviations. This went down to 7. Now I understand morning panic is always, a force to be reckoned with, but let's go to this week, right? Let's go back here. 7. Look at this one, right? Look at this candle right here. 7 standard deviations, 8 standard deviations, 9 standard deviations. Again, it's a morning panic, so you got to expect some of this stuff, but there is such a small chance of this happening randomly. This is definitely, to me, an indication of institutional control over the stock. Meaning somebody, because of all the dark pool activity here on Monday, and then all the options activity here on Tuesday, and then the fact that this is going back up, it indicates to me that institutions need Tesla to stay up, to stay high, to prop up their accounts. Like one of these days, I really need to make a quick video about how margin accounts work with shorting, with short selling, because man, there's a lot to go into there. I'm gonna try to keep it simple though. All right, anyway, let's go back to GameStop because we're getting sidetracked here. If you want to make Tesla, or sorry, I'm still thinking about it. If you want to make GameStop's stock go higher, the secret is not in trying to convince all your family and friends to go buy the stock, okay? That arguably could be collusion, and we're not here to do that, right? As long-term shareholders who really care that the company sustainably grows into the future, right? Because that's what the company wants, right? Creating long-term shareholder value. That's what we're here for. How do we do that? We should look at this interview by Jeff Bezos. I'm going to play it for you here in a little bit. But if you go on YouTube, you can watch the whole interview. Type in Jeff Bezos free cash flow in the search bar, and this pinkish looking video by the channel Investment Knowledge should pop up. Okay, and we're going to skip to 2 minutes and 37 seconds and listen to what they have to say.
And so lots of CEOs, I'm sure, would like to learn from you, how is it that I can not be at all profitable and still have an incredibly high stock price by some measures? What is your advice? Is it spend many years explaining we're never going to earn a penny because we're going to be reinvesting it?
I would say, it's very difficult for a publicly traded company to switch. So if you've been holding a rock concert and then you want to have a ballet, that transition is going to be difficult. But if you've
That's what GameStop's going through right now. Everybody sees them as a video game brick and mortar retailer, and we're trying to transition into e-commerce, into consumer electronics, into apparel now with the new clothing line, with collectibles as well, with sports memorabilia, Pokemon cards, other collectibles, toys as well. Like GameStop, you got to go on the website and look at all the stuff that they sell. They sell a lot of cool stuff, and that's part of the growing pains here. And that's part of the transition. All right, let's continue.
done it from the very beginning, and then I think it's not that difficult to do. Look, we would all love all of our numbers to be smooth lines up and to the right, and that would be terrific, but that's not how it works. Those numbers are output measures. And I guess you could try to manage your quarterly earnings very precisely, but I think personally that would be a mistake. Most of the work that we put into any particular quarter happened years ago. So it's not, there aren't that many knobs you can turn during a quarter. I mean, you can, but they're like eating your seed corn if you turn those knobs. You don't want to do that. And so people, I think if you focus on the controllable inputs to your business instead of the outputs, in the long term, you get better results. So the Benjamin Graham quote here is that in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And I think people are well advised to build a company that wants to be weighed and not voted upon. And that means having good return on invested capital and having lots of free cash flow. But if you said to me,
Two things there. Return on invested capital and free cash flow. Those are the two major inputs into a larger share price, into a rising share price. And so return on invested capital could be the business ventures that GameStop chooses to pursue. And two of those things right off the bat that I can see right now is this, new line of apparel and the, rumored NFT marketplace. Now we're 99.99, or at least I am, percent sure that it is going to be GameStop making this NFT marketplace. But as far as the apparel line goes, some people may think it's weird for a video game retailer to be selling branded clothing, but I don't think that's weird at all. And here's why. First of all, you have to consider the shipping crisis going on right now. Off the coast of California alone, there's 111 ships filled with containers, up to 1.5 million containers, packed with goods for all sorts of stores in America that can't offload. And there's not enough truckers or chassis to load the containers on for truckers to drive them everywhere. It's a complicated situation. I won't get into it, but you got to imagine that GameStop has a ton of inventory out there that they can't get to, that they can't obtain, and then because of that, they can't sell. And so what do? I think the clothing line is something that they could get quickly to sell now while they have a lot of inventory floating out there, right? So that's potential return on capital investment if they can make a good profit on the clothing line. The NFT marketplace is another one. I can see that they've been putting a lot of resources into building this thing because of all of the hires in the crypto space in the NFT market, nft.gamestop.com that we've seen, and this potentially can be huge returns on investment. Real quick, let's go to cryptoslam.io and we can see. So CryptoSlam tracks all the NFT sales, and the biggest marketplace is OpenSea, and potentially this marketplace will compete with OpenSea. So we can look at all time. Look, just Axie Infinity alone has pulled in $3.24 billion. That's a lot of money. And OpenSea takes a 2.5% cut. Now imagine if GameStop could get a piece of that action, right? And this is just one of the collections here, right? CryptoPunks, obviously huge. Bored Ape, Mutant Ape, all of these projects. And NFTs are in their infancy. And people think that gaming NFTs could be 100 times the size of art NFTs. Like imagine if all the people who played Counter-Strike or Valorant, you know, or League of Legends or whatever game comes into the future or gets popular now, if their in-game DLC or skins or whatever, if they were all NFTs, and then imagine the secondary market of people selling the things that they bought, and GameStop taking some percentage cut of it, you know, maybe less than 2.5%. By the way, OpenSea, as the biggest one, they don't have a bug catcher program either. So if somebody catches a bug and exploits it, people could potentially have their assets stolen, maybe, right? And with Loopring, they are decentralized, and I believe they're open source. And so as long as they can offer a bug catcher program and have the community work together to improve it, this potentially could disrupt OpenSea and the other ones too, because Loopring will make minting NFTs much cheaper. So all the creators, the artists, you know, the musicians, photographers, whoever is making NFTs and selling them, it would be better for their bottom line to be on this new marketplace that we're expecting to be announced anytime in this quarter, right? So that is return on capital investment if that marketplace takes off. And this is you know, a call to action for all you artists out there is, if you're in GameStop and you care about NFTs and you're into this, even if you're just like skeptical but kind of curious, just be ready. You know, when this marketplace launches, it's gonna be fun. It's gonna be interesting. I know. So if you've got content that you want to publish, be ready to publish it. All right, let's go back. What were we talking about? Did we talk about this already? Yeah, we did. All right. Return on capital investment, right?
If I said, here's a job I would reject. If somebody came up to me and said, Jeff, I want your job to be to drive up the Amazon stock price and just manage that directly. Now, this might sound ridiculous to some of you, but many companies actually do this. They actually go out and they try to sell the stock. That's kind of the final output. And it's much better to say, okay, let's not do that. That's not going to be sustainable. It's kind of a silly approach. What are the inputs to a higher stock price? And you say, okay, well, free cash flow and return on invested capital are inputs to a higher stock price. Okay, so let's keep working backwards. What are the inputs to free cash flow? And you keep working backwards until you get to something that's controllable. And a controllable input for free cash flow would be something like lower cost structure. And then you back up from there and you say, okay, well, you know, if we could.
Lower cost structure just means, you know, SG&A. It's like how much it costs to run the business. And part of that is, you know, just what pops into mind. Shout outs to King Diamond Hands on Twitter, @thatneighborboy. He ordered a really nice ultra wide screen monitor, like a curved ultra wide, and it arrived broken. You know, I'm not going to point fingers. It was delivered by FedEx, and the box arrived damaged, and the monitor was destroyed when he opened it. Doesn't matter whose fault it is. It's costing both companies money, both FedEx and GameStop money. And these are the sort of problems that need to be worked out. And like, I'm sure GameStop is working on it. I'm sure FedEx is working on it. But there are other things that make the cost of doing business lower too. And so these are some of the things that the company needs to work out. But also, we as shareholders, as a shareholder, you're a partial owner of a company, right? And we're going to get to this in a minute, but I want people to be thinking about how they, as long-term shareholders who care about the future of the company, could work on helping out the company. And it has nothing to do with the stock, okay? It has nothing to do with getting people to buy the stock. As we've talked about already, because of dark pools and all that other stuff. That's not important. The day-to-day fluctuations of the stock price is not important. It's fun to look at. It's fun to talk about, but it really isn't important.
We can improve our picking efficiency in our fulfillment centers and reduce defects. Defects are very, very costly. It's probably, reducing defects at the root is one of the best ways to lower cost structure. And so then that starts to be a job you would accept. You would say, if you're a reasonable person, you would say, I have no idea how to drive up the stock price. I can't manage that directly. It's not a controllable input. But I can make your picking algorithms more efficient. And that will reduce cost structure. And then follow that chain all along the way. That's what you do in all of these businesses. You want customer obsession. You want to invent your way out of boxes. You want to invent your way into the future. You want to be patient. And you want to have operational excellence so that you're finding defects at the root and fixing them.
You talk about what a lot of CEOs do in terms of trying to drive up the stock price, selling the stock. You told me something when we were outside, extraordinary, which is that you spend 6 hours a year.
Okay, I went over a little bit, but again, these are the things that we should be thinking about, right? And it's ironic listening to Jeff Bezos talk about this because, in a way, we're directly competing with Amazon. Anyway, moving on. I want to point everybody to an old Roaring Kitty Keith Gill deep fucking value tweet from a little over a year ago. He tweeted this on the 5th of November, 2020. He lists a bunch of articles, okay? And they're all pretty decent articles, and I do think that it's still worth reading through them a whole year later. But especially, I want people to scroll down and look at this one from Seeking Alpha, the one about PlayStation. Okay? The title is GameStop likely already has digital revenue sharing with Sony at up to 10%. And this came out October 21st, 2020. Okay? This one I thought was a very interesting article because it talks about a lot of the things that we just saw Jeff Bezos talking about. Okay? And namely, it talks a lot about CAC, which is customer acquisition cost, LTV, which is long-term, lifetime value that a customer brings. And there's this ratio, okay, between how much it costs to acquire a customer and how much that customer will spend at GameStop. And it also talks about TAM, which is total addressable market. And I think it also touches on SGA, which is generally it's the, I forget what it stands for. It's the cost of running a business. No, that's not it. Selling, general, and administrative expenses. Okay, that was brain fart. Sorry. Anyway, so the cost of acquiring a customer. Companies spend money on advertising, right? They advertise, they, mail you things. Maybe they have people on the street handing out flyers. Like whatever it is, it costs them money to be able to try to convince somebody to go shop with them. And an example of that we could use, a model that we could look at, is Tesla. Again, Tesla famously says that they have never spent even a penny on advertising. And they've got a lot of people that do the advertising for them. And that could be us as shareholders, right? Again, as a shareholder, you are a partial owner of a company. And so the way I see it, it should be incumbent on us to try to take that role on seriously, rather than just buying stock and sitting back on our butts complaining that the stock price isn't going up and yelling at, this person or that person or other people, SEC, whatever. Like, none of that is important, right? Because if we can help GameStop get to the point where the company is undeniably successful, it won't matter. None of that stuff will matter because institutions will want to get a piece of that. I think the potential is there. I think all the pieces are being put in place. But this is a long-term play. This is always, I've been saying this for months, this has always been a marathon, not a sprint. People, are in this thinking that this could be a quick, short squeeze play, get in, get out, and be done with it. And I just don't know if that's the wise thing to be aiming for. I think the potential for that is there too. Don't get me wrong, right? But from a sustainability perspective, this is what we have to do. Because, you know, Amazon addiction is real. Walmart addiction is real. Costco addiction is real, right? People like to go to these places for those things. But there's so many more reasons to shop at GameStop instead, right? They have deals all the time. They sell a ton of stuff, right? I mean, you can go to the tab here, browse the website, and you can find new stuff being offered all the time. You can look at the deals and see what they have on sale all the time. They have apparel now. They have high-end PC gaming equipment with more and more stuff being added all the time as soon as they get inventory for it, right? I mean, accessories, games. They have board games too. They have popcorn makers and waffle irons too. I mean, it sounds weird, but they do have it. I kind of want to get one for my niece, right? A Mandalorian, Boba Fett, you know, Star Wars. What is this? Dragon Ball Z. Like, you know, random stuff maybe, but some people like it. They were selling Halloween costumes for Halloween. They're not just video games, right? They sell all sorts of collectibles. You like Harry Potter? They sell lots of Harry Potter stuff. And it sells out all the time. Like, this stuff sells out fast. Right, look at this. Harry Potter Death Eater set. 16. Like, I mean, I'm sure somebody would want this. That's, I mean, that's cool. I like that. I might get that. So yeah, and the Power Up Rewards membership is one of the best memberships that I've seen on the internet. Right? It does cost $15 per year to join, but you get $5 right away. And I think I've seen this bumped up to 10. You know, double check me on that. But $15 per year, and right off the bat, you get between $5 and $10 off already. And every month, you get another $5 off. I think you have to go in store for it, but that's okay. You get more trading credit. You know, you get points back. If you're a pro member, you get double the points back. A free gift for your birthday. I mean, I don't know what that is, but that's got to be worth something. But especially if you're in the market for like a new console, a PlayStation 5, an Xbox Series X, the OLED Nintendo Switches, which are like, these are all practically impossible to get, and the holidays are only coming up soon, right? This is where you want to be, because you get first access to all of this stuff. If you add all of this up, all these benefits up, you get more money back than what you pay for. I mean, I think that's worth it. And the weird thing to me is that people don't know about this. People don't want to sign up for this. This is worth it. If you shop even a couple of times at GameStop, this pays for itself. And people still don't want to sign up. And I think that's something that we can help out with. Getting people to shop at GameStop, getting people to sign up for Power Up Rewards Pro memberships. Okay, and the points you get now, it used to be $5 minimum, and now they've reduced it to $1, and you can also donate to charity with your points. I mean, options are always good, right? Having those options are always good. Okay, we're going to move on to talking about the TAM, or the total addressable market. And everybody thinks that GameStop is just a video game retailer, a dying brick and mortar video game retailer. People still think that to this day. And if they only sold video games, consoles and whatnot, I could see that. The total addressable market for global video games is $151 billion in 2019. But globally speaking, it's been growing really fast. Look, in 2020, it's 173.7. And it's estimated that by 2026, it's going to be over 314 billion. This is a fast-growing sector, okay? Not to mention, like, online gaming, esports, in-game, you know, microtransactions, DLC, skins. Like, imagine if all the people that played Call of Duty and Counter-Strike and Fortnite and League of Legends or whatever the next game is that really makes it big, right? If all of those skins, cosmetic items in-game, had a market on like an NFT market that was run by GameStop and Loopring. I mean, that's huge, and that's not it, right? Like, Consumer electronics. GameStop's starting to sell consumer electronics too. 450 million, almost $500 million. Expected to grow by a lot. You know. Yeah, it's expected to grow 34.9% by 2025. That's not that far away. They sell toys, you know, almost 100 billion. Collectibles, 372 billion. Right? GameStop does sell collectibles, although people don't know them for that. And with an NFT marketplace, making sure that there's no counterfeit goods being sold. I mean, that's value if people transition over to that marketplace. Software, 1.5 billion by 2025. Trillion. I misspoke. Almost a trillion now, and almost 1.5 trillion by 2025. I mean, let's just call it. Million, billion, trillion. Like, even assuming GameStop can capture 1% of that, and you divide that by every share, I mean, there's a lot of problems with this calculation, I know, and if you give it a 15 multiple, you know, there's a lot of problems with my calculations. But my point is that GameStop has grown their total addressable market by a huge amount. And if they can capture even a tiny piece of that total addressable market every year, this stock, in my eyes, is undervalued. Okay? And I wanted to touch on all the bearish sentiment going on this week again. I made a video yesterday about it, or the day before, rather. And GameStop historically has been a cyclical company, right? It pops in quarter 3, quarter 4 in revenue. It makes sense because this is the holiday, you know, buying season. But I wanted to point out something. In 2019, the estimated revenue was significantly higher than the actual revenue, and that's bad, right? Estimated is always higher than actual. That's bad. But then something changed in 2021. The estimated is now lower than the actual, which means we're beating expectations. GameStop has this weird pattern of always selling off sharply after earnings. Every quarter after the earnings call, the stock just seems to dump irrationally. And that was true in the most recent quarter too, but then it recovered almost fully by the next day. You know, so something weird is going on, I think. But that's neither here nor there. I mean, if you've been following along, you know exactly what's going on. So yeah, we're entering into Q3, and if you look at history, every Q3 we pop. Q4, I don't know what happened to Q4 in 2028, but you know, revenue pops, and the stock price, I think, should follow along. If we look at free cash flow, we can graph that. So this is this is macro trends. Yeah, macro trends, free cash flow. So if we look at, and I spent some time looking at annual free cash flow, we can't deny that it's been going down. And 2020 was a horrible year for everybody. And a couple of things to note about this. The 2021 numbers, because GameStop offsets their fiscal year, 2021 is actually 2020. So it's lower because, you know, presumably pandemic, people still, you know, thought negatively about the store. Amazon was growing while GameStop was shrinking, but things have changed. You know, we haven't even seen the 2021 numbers yet, which will be reported in the beginning of 2022, because Ryan Cohen doesn't even step into the picture until partway through, like most of the way through 2020. So if this number pops, I mean, we can call that the Ryan Cohen effect, and we'll have to wait, right? This number won't come out for a while. The next earnings for Q3 is in the beginning of December. And so we probably won't even hear the Q4 numbers until February or March of 2022. So we'll have to keep following along. Looking at quarterly free cash flow. Again, it spikes. It's a cyclical stock. And I guess the trick is to smooth this out a little bit more. And if GameStop can successfully transition into a consumer electronics, e-commerce, NFT marketplace, you know, if they can attract non-seasonal business to the company, this free cash flow will be a lot more stable, and professional investors, I'm talking about Wall Street now, okay? Institutions, they're going to see that, they're going to like that, and they're going to want a piece of the action. And I think they're really angry at us because we won't sell our shares, because at this point in time, because the marketplace isn't here yet, because the numbers haven't come out yet, and we haven't totally seen all the results of the vision that Ryan Cohen has and the rest of the team over at GameStop has, the direction that Matt Furlong is taking the company, right, the CEO. You know, they're going to continue calling GameStop an overvalued, you know, potentially worthless company until the company becomes undeniable. And I do think we're on that path. So if we can smooth out the free cash flow, if we can increase the free cash flow, that's going to be really good. I'm going to wrap it up here. If you want to do a little bit more digging and homework yourself, go look up the free cash flow of any of the major blue chip companies and see what they're at, compare it to GameStop, and consider that a target goal, an aspiration. And if we can get to that point, like, I mean, just imagine the possibilities of what can happen to the stock. On top of the fact that it's still decently heavily shorted. I think it's much more heavily shorted than what they're reporting, but, you know, I'm not going to talk about that here today. Okay, everybody, if you're still listening, thank you for listening. I appreciate you. Have a good rest of your day.